My view is that we're probably going faster into recession than anybody expects and probably much deeper.
Hey guys, welcome back to Library of Wealth. Today we have Raoul Pal giving us an update on Bitcoin, Ethereum, plus his view on the current financial market and how the economy is faring under the current conditions. He'll also go over the economic decline we're seeing in the market. According to Raoul, the recession is no longer a possibility, but rather our very reality. Many financial experts were concerned when the Fed declared many interest rate hikes this year to combat the record high inflation we're experiencing currently, and because of the economic slowdown, this will have a significant impact on the crypto markets as well. One of the most surprising events happening right now in the current market is the 1-year rate increasing by 800%. There's a noticeable interest rate increase happening right now across equity and home markets and is causing refinancing to skyrocket. The rise in oil rates, mortgage rates, yields, and the dollar, this is playing a major role in market volatility. Let's listen as Raoul gives us his take on the crypto market and his financial outlook for the rest of the year. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
My view is that we're probably going faster into recession than anybody expects and probably much deeper. I think that's coming. I think we've got a replay of 1974 underway, which was the ISM the Institute of Supply Managers Survey, which is a good guide to the business cycle, went from 56 to 30 in 4 months. Similar setup with oil prices screaming higher, supply restrictions, rates going up, the Fed hiking, all of the same stuff. And there's several of these in history. Equities don't like it generally. The bond market tends to turn earlier, which I've been waiting for, and bonds have started rallying to say, you know what, things have gone too far. I still think we probably have another leg lower in equities into the final low, much like we had in 2018 as well. So I'm not short equities. I've been buying bonds and I've been buying kind of growth equities, all the stuff that's super beaten up, because I think that the cycle plays out faster than people imagine. And the outcome is a U-turn by the Fed. Yeah. This chart is rate of change of mortgage rates, 2-year rates, oil, gasoline, and the dollar.
Yeah, this is a good one.
Of the business cycle. It's suggesting we've just had the largest monetary tightening in history. Yeah, and that what they've done, the markets have done, because the Fed were barely involved. Yes, you're right, they're jawboned, but what they've done is cemented in the KK precipitous drop. As I said, that the last time we saw something like this was 1974, and it was over pretty quick. Now, it depends whether it's a quick thing or a longer thing. I think it's a quick thing. So as soon as the ISM approaches 50, they stop. Because obviously below that, you start seeing unemployment rising, other bits and pieces. So my guess is we get an ISM print of around 52 below consensus. And then by July, it's below 50. And so they're done. That's my view. I think it's done.
Raoul goes on to say that he believes the leading platform Ethereum will likely outperform Bitcoin in the long run. Powell says that even though the top crypto asset by market cap beats Ethereum in total trading volume and number of active wallets, Ethereum has found a way to outperform Bitcoin over the last few years. Bitcoin exchanges more value each week than Ethereum does, but Ethereum has a lot of transactions. Raoul says transactions are a little misleading because of its total value and number of active wallets, and Bitcoin beats both.
I've got a lot of charts that look like this, but this made total sense because I've been saying that the increasing fixed costs, commodity prices, PPI, all of that stuff was going to destroy consumption, demand destruction. The dollar was always a problem because it went up quite fast at a rapid rate of change. And rates have gone up, 2-year rates and 1-year rates have gone up at the fastest rate of change in all of history. 1-year rates in the US have gone up 800%. And wow. People say, well, that doesn't matter because the rates are low. I was speaking to a good friend of mine last night, big family office, multi-billion-dollar family office. And he's like, oh yeah, we refinanced everything. And I'm seeing it with all my friends. Everybody who's refinanced their stuff is now seeing massive interest payment increases. That's the rise in the oil price, which is a tightening of conditions, the rise in gasoline, the rise in mortgage rates, the rise of 2-year yields, and the rise in the dollar. Now, the S&P 500 right now is pricing in an ISM of around 47, around recession level. it kind of suggests that it might need to come a bit lower, but it's against a good comp from next year, so it'll come lower anyway. So the year-on-year rate of change versus the ISM. So I don't know when this turns up, but as yields are turning now, oil, I think, breaks as it did every time we've had this setup. Oil breaks as well, then we're going to find that this chart will start hooking up and we can start looking forward. It feels like all of this is going to play out faster than anybody imagines. Faster downside, faster upside, I think. But, I don't know, because Urian's right. If we end up in this situation where inflation doesn't come down, I actually think it goes negative. But if it doesn't come down, then we've got a longer term issue that could be more of a bone crunching bear market. I looked at this separately and I tried to figure out what was the idiot proof method, because I'm a lazy macro guy and I'm not as talented as Urian in building models. So what I try to figure out is how can I model network effects in a reasonable way? And I did a lot of work on it and I found it was the two things together explained pretty much everything. It was the value exchanged, let's say on a weekly basis or monthly basis, you choose it, in dollar terms, multiplied by the number of active users. Now, the number output is not important. Just put it against the price. It's identical to price, and it doesn't have price in it. So it's telling us that the market is pretty efficient at pricing the network. Now, what Urian's saying is the network growth is the thing we're trying to estimate, right? Because then you've got the real value add. If you can forecast network growth, then you can basically forecast price. But I figured out how to forecast how to value price. Market's bloody good at doing it. The only one that's traded somewhat differently, and it's too early to say, was ETH. It traded at a premium to that, and I think it's to do with the burning mechanism that meant that we've got a slightly different supply structure. So I would probably have to model that out, but I'm not smart enough, but I'll figure out how to do it at some point. But it was the value. So if you think of Bitcoin exchanges more value each week than Ethereum does. Ethereum has a lot of transactions. It's a red herring. Transactions are a red herring. It's total value and number of active wallets, and Bitcoin beats both. However, if you look at Ethereum, the change in values, the rate of change in those two values in Ethereum is higher, which is why Ethereum's been outperforming Bitcoin over the last couple of years. And I found it's really useful. Listen, if you believe the future is in the technology, in blockchain technology, then this whole digital asset space should outperform the safe haven. That's just how things work. It always works that way. And therefore,
there's a higher beta.
And if you're in an exponential uptrend, because you're in a network adoption model for the entire space, not just for Bitcoin, then it should outperform over time. It's as simple as that. It's not a value statement about I don't like Bitcoin because X and I prefer Ethereum for Y. It's all about network adoption models. Once you understand that, you free your mind of all of the narratives that are in the different buckets.
Raoul goes on to say in his interview that in his macro view, we are in fact headed for a recession, not just in the cryptocurrency market, but in the stock market as well. He believes it could be pretty bad initially, saying that the Fed shouldn't have done what they did, but the bond market tightened for them anyway, and that it wasn't the Fed that did it, but the bond market did it all. The Fed are going to have to unwind it, and it could get messy. Using all the technical indicators that Raoul uses, his view is if we are going to reach a proper bounce or low, it happens in June. So between now and June, everyone is likely to panic. If the central bank reaches the inflationary threshold, Raoul feels the Federal Reserve will have to intervene. Many analysts feel that the current banking system is on the verge of a collapse, and that the fiat currency world will have to make a major adjustment, or else it will ultimately come crashing down. However, there may be a ray of hope at the end of the tunnel. Raoul says he still sees a potential bear market ahead. What do you think about Raoul Pal's interview on the crypto and financial markets? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.